For our next presenter, we're going to be introducing Melissa Armo. She founded the Stock Swoosh in December of 2012. The Stock Swoosh is an educational firm that empowers traders with a complete and detailed system to become profitable traders. Melissa graduated from magna cum laude from Gettysburg College with a bachelor's in philosophy and a minor in Latin and political science in 1994. She was employed for several banks and brokers in Pennsylvania, Florida, Arizona, and New York as a mortgage broker for 17 years. She changed careers from banking to pursue a security trading career in 2008. She's also a self-taught day trader with over 5 years of experience. Her specialty is a trading strategy that focuses on shorting stocks that gap. And in her free time, she likes to work out, read, write, and dance. And she loves New York City and James Bond movies. Without further ado, ladies and gentlemen, our next presenter, Melissa Armo.
Welcome. Thank you so much. Thank you, everyone, for coming today. I appreciate your time. Hopefully, everyone had a wonderful trading day today. I'm going to actually talk a little bit about the live market today after I'm done here with my presentation. My name is Melissa Armo, and today I'm going to talk about trading on the side of institutional money. I do own a company called the Stock Swoosh LLC. If you'd like more information, go to my website at www.thestockswoosh.com, and you can email me at melissa@thestockswoosh.com for more information. I have a lot of videos on YouTube, and this video will be on YouTube as well. So let's talk about institutions in the market. A lot of people today were talking about directional bias, and I 100% agree with that in the case that you do need to trade with the trend in order to get momentum. And directional bias and trends in the market are created by institutions who set the tone for a stock's move on the day. If you become a specialist in defining what institutions are buying or selling, then you will have a huge advantage in your trading. Do you know what institutional positioning looks like? Think about this, like pull up a chart, pull up any chart and ask yourself if you could pinpoint exactly what's going on in it. Is someone buying it? Is someone selling it? Is someone shorting it? Who are these institutions in the market? Hedge funds, banks, large companies, large investors, etc. I mean, there's a lot of them. But it's really, really big power people, okay? It's not like individual people like me and you. And actually, if we took everybody here today, and if the market was open right now and it's closing in 5 minutes, and if I called a trade and we all did it together, we wouldn't even be able to move anything. We wouldn't. So everyone here today, we would not be able to move a stock. This is institutional positioning is massive, okay? It is nothing that any group of traders could even trade against, and so that's why you have to be with it. So actually, let's talk about the Qs. Okay, Qs are about to close in a couple minutes here, and I just want to point this out because a lot of people probably didn't understand what really happened here today in the market. I'm going to throw this out here and tell you right now that the market is still bullish. Okay? The market is still bullish. And if you bought something in the market today, you might have had a difficult time because the market intraday today was bearish. Yes, it was. Market gapped up today and actually fell in a bullish gap up. We're going to talk about this later, but the market did gap up today. Market gapped up. Market's in an uptrend. Qs are in an uptrend. And guess where the market came today? Into the low of the day, into the afternoon, and bounced. It was a weak bounce, but it did bounce to the target. This low, this little taily guy right in here that was on March 3rd was 88.87. If I drew and made a chart myself in a graph and made all the numbers and said, Melissa, what was a short target today? I couldn't have drawn it any better. So this is actually reading price. I'm reading the price here, and the market short today went to the target. There. I want to also point out the market's in an uptrend. The market's holding the uptrend. The failure of the bullish gap up today doesn't break this chart in the market, and the market is holding the uptrend. Market is not extended. Market is going to follow through higher. Market's going to follow through higher this year in 2014, and that's my call for the market, although it did not follow through higher today. Every time the market gets up here, it's making new highs. I talked about this in the trading room because the bears and the bulls are like fighting over one another right now. Because the overall bigger picture turn is bullish, even though for the short term here today, the bears were in control of what was going on. So don't be surprised if you get up tomorrow morning and see the market fall through higher again. I mean, I would not be surprised. Why? Because institutions in the market that are in control of the market right now are the bulls, even after today. Okay? So The goal of trading for you individually and for anyone, even if you're in a
Welcome to GoToWebinar, Webinars Made Easy.
goal of a trader is to be profitable. It may seem commonplace to have to point this out, but a lot of traders don't think about this day to day. Okay? And you do have to think about this. It's common sense, but I got to point it out because traders forget that their goal as a trader is to make money and be profitable. If you take bad trades, you won't be profitable. If you take trades against the directional trend, you won't be profitable. If you trade against institutions, you won't be profitable. If you trade against institutions, you won't be consistently profitable in your trades. And if you trade with institutions, and this is the good news, you will have a higher odds of being consistently profitable and you can actually make money trading. And consistency counts. Because you don't want to get up every day and have these huge swings, huge up days, big down days. You're all over the place. It's an emotional roller coaster, and that's not the right way to trade. The right way to trade is to be consistent, and that means you have to trade with the trend, and that means you have to trade with what institutions are doing. And guess what? You could be in a stock that is in a trend. The trend could be set. You could be in it. You could have made money today on the long side if you were in a stock that an institution was buying despite the fact that the market fell in today intraday. And we are in a bullish market anyways, but making money consistently counts. It's about chunking it out. You chunk it out. Every day you get up and you chunk it out. It's not about having these huge home run days and then giving back all the money like in the next week and then having another huge day and then giving it back. It's about chunking it out. This is how you actually make a living doing this if that's what you want to do. And even if you don't want to make a living as a trader, I still think you have to make money consistently. Otherwise, it's really not that much fun because it's not that much fun to lose. It's fun to win. Okay, it's fun to win. So it's about day after day. Making money consistently accounts. What does that mean? It means never losing a lot. It means losing only a little and not losing that often. It means making money often. It means making a lot when you do, and this helps your confidence level too when you're profitable a lot of days. You get up in the morning and you feel like, well, I'm going to trade today and make money, like you assume that you will. You believe in yourself. You believe in the market. You believe in your strategy, whatever it is. And being a good trader is about making money trading day after day, chunking it out. Look for quality trades. It's not about just looking for something to trade for the sake of trading. I actually didn't trade today. I did everything that met my criteria. And guess what? I'm like the shorting queen. And I did not short anything today and the market fell. Why? I didn't have anything that met my criteria to trade. And I was a disciplined trader and I didn't trade. Okay? And I did call a good bullish gap actually, which is hilarious because the market fell in. And I'm going to show it to you later today. So it's about spotting quality and then playing it. It's also not about getting some big home run. It's about chunking it out. A lot of people want to get bargains. They think that if they get something that's bottoming out, okay, and buy it in the lowish areas, they feel like they can get it up into a rally. And a lot of times people do this with companies that they love. Apple's a great example here because there's no bargains in Apple. First of all, no one should be looking at this as any kind of bargain at this price point. At a $500 price point, you better darn well know what you're doing if you're going to trade Apple. Whether it's an option, whether it's intraday, it's day trading, overnights, it doesn't matter. This is not a stock that you mess around with. Apple's in a downtrend. It's confirming the downtrend from the failure of the earnings report to carry this through higher than happened in January. Now, the earnings are out, I think, in April for this. Again, we'll see what happens. And I didn't look at how Apple closed today. I'm sure that it closed weak along with the market, but Apple already is weak. There were many, many people that tried to pick Apple up in this area here and was bottoming out. This was back at the end of last year. Failed, failed, broke. Then it started to bottom out again. Failed, failed, broke. Then it broke again. And every time people kept trying to pick this up. Now, if you did buy Apple here at 400 and happened to hold it up all the way here, did you make money? Yes. But was that a good trade? The answer is no. Why? You would have bought something in a downtrend. You'd be playing against the power money that's in the stock, and the power money that's in the stock is to the downside. It's in a downtrend. And this is not about bargain trading. It's about chunking it out, not getting some huge home run. When you buy Apple at 400 and someday gets up to 1,000. Okay, trading is not like investing. Trading is trading for money to chunk it out. Here's another great example here, FIO. Many, many people bought FIO in this huge big bar that happened back here. This was in September. Then the stock gapped down here in October. And if you bought FIO in here in this bar, around anywhere from $12 to $12.50 or even over 13 bucks, thinking it was going to hold, and this is on the 50-period moving average, you lost. You lost in the trade. And I'm sure people are trying to think about buying this again now or might even bought this again now. FIO, again, is still in a downtrend. The institutions are selling this or shorting this. FIO is not along. Again, no bargains, thinking that you're getting this on the cheap and it's going to go all the way back up to $20. It's not the right way to trade. So making money trading is about consistent and correct trade selection. Making money trading is about correct trade selection. It's about getting the directional bias right consistently to know what direction to take the trade, whether long or short. Trading successfully means focusing on taking trades with institutions, and being on the side of institutions increases your odds to make profits because institutions make stock trends and the trend in the market. Institutions move stocks either up or down, okay? So if you want to get paid, then the key is to be in the trade with the large directional moves. If you are trading with institutions, not only are you on the side of momentum, because institutions make momentum, okay, you're also trading then with professional traders. So even as an individual, you will be more successful if you trade like a professional, even if you just work for yourself. Even if you just have a very small account and you're by yourself in your own house and nobody's checking on you or looking at you, not to report to a boss. If you act like a professional and make decisions like a professional and take what you do seriously when you take a trade, you'll have a higher chance and odds of success. You know, I always say act like you have $1 million in your trading account and you're taking a trade of risking that even if you're not. Would you want to buy FIO if I gave you $1 million? Would that be the pick that you would do? I would hope the answer would be no. But the whole point is that you want to find stuff that's quality, that's with institutions, and you want to act like a professional, even if you have a small account. Here was the golden gap for today. This was WSM. WSM, look what this stock did today and the move that it had today, and look at what the market did today. This is an example of institutional buying. So let's go over it. WSM actually closed. This is last night, the night before. Today's Thursday. This is Wednesday. Wednesday, WSM closed around $59. Gapped up this morning, gapped up over 63 and rallied. Target, this really could have gone to $70. Target for this as an overnight is $70 for a longer-term swing trade. It did not get there today, but it had a massive move to the bullish side against the market. Still had a huge move today. I don't know if it closed. It actually got up over 66. Got up way up over 65 and almost to 66. Target really was, first target was 65, and really could have gotten to $70 today if it had the market with it, but it didn't even matter. Institutions bought this stock. That's how this did this thing. It closed last night at 59. How did it go from 59 to 63 and then to 65? Institutions bought the stock. And not only did they buy it to make the gap, they pushed it higher on the day. So that's the great thing actually about what I do in gaps is that it didn't matter what the market did today. This worked anyways. Why? Because institutions came in, bought the stock, held the stock higher, held it in midair, mind you, and ignored the market completely 100%. So this is what buying looks like. This is power. This is power. It takes a lot of energy, a lot of momentum, a lot of power to move a stock from $59 to almost 65. And so I know a lot of this and they say, well, they think it's going to fill the gap. It's going to fill the gap. The market's coming in to gap up for its gap. It's going to fill. Right now, I'm going to tell you right now that's not the right way to play gaps. Okay, this gap fill is not the right way to trade. It's not a strategy at all. Okay, we're looking for institutional buying. This either has it in a bullish gap or it doesn't. And how are you going to know that? Well, we're going to talk about that later. Here's another good example here, a beautiful chart here, this ATHN. Let's go all the way back here actually from last summer. ATHN gapped up in July. I don't know why it doesn't even matter. Gapped up here over $100. This gap is still in play. If you bought ATHN as a core trade, on here in July, look at how much money you made. You doubled your money in about 6 months in ATHN. Gapped up again here around 120-ish. This gap is still in time. Gapped up here again. What is this? Institutions buying it. Bought it again here. Rally, gapped up over 150 and flew higher. This is into the beginning of this year, and this chart is still holding up beautifully, even though the market came in today. It doesn't matter. Market's strong. ATHN is strong, and this is institutional buying. How could a stock go from $100 last July to make new highs up to 205 6 months from institutions buying the stock? Okay, that's how. And so this is not something to be shorted. This is extended. This is strong. This is getting bought. Institutions believe in this thing, whatever the reason is, it doesn't matter. Read the price and see what's happening here, because it's real. You can even look at bars, they're massive. Here's an example of institutional selling. And just from today, BBBY had a beautiful gap back here. This was in January. This is an example of institutional selling. Stuck down here, broke, closed the night before up here around 79-ish, gap down the next day, this is back in January, broke 73, broke 72, fell off a planet, and actually this is a really good example of the power of institutions in a stock, because when they said dump it, and they said this thing, and they're in it long, and for whatever reason they wanted to do it, it doesn't even matter. You read the gap, you see they're going to dump it. You short this stock as a trader with the institution selling out of the long positions. It drove the price down. It actually went down and broke more than $10 in like 2 weeks. You could have actually shorted this as a day trade hell overnight and just sat back and sat on your butt and made money. This fell off a planet. Setting up as a short again today. Setting up as a short again today. BBBY is a short. BBBY is selling off with institutions. Again, it doesn't matter if you think this stock is recovering here, because it did a series here of lower or higher lows in here. That's the incorrect way to look at this. It's in a downtrend. The chart is broken. It's going to get sold off more, and it did get sold off more today, and this has nothing to do with the market. This chart is lower, okay? So see it for what it is, selling. Selling in BBBY, institutional selling. Another great chart here, JCP. This is everything in it now. This has institutional selling. This has shorting. It's like nobody even wants this thing anymore. And I'm pointing this out because it's one of these stocks, and I will bring up this chart in a bigger picture later in the webinar today, that I know people are trying to get a bargain here. I know people are thinking, oh, I'm just going to buy this here. I'm going to buy this. It can't go any lower. Really? It can go to $1.50. It can't go any lower when it gets to zero. When it gets to zero, then you get a bargain. Then you can buy it, but it's bankrupt then. So I really wouldn't buy it at zero, but you could if you want to, okay? Something can always go lower, just like something can always go higher. And it's institutions that are controlling these stocks, and you have to be able to read what's happening. This is not about the bargains. It's about reading the footprints of institutions, and they're very prevalent. They're very big. They're there. It's like, really, to me, and now I've been doing this for a couple of years now, but it's so obvious to me when I see something like this, to be able to see what's really happening with something. What's really happening with something that's really going to hold and follow through and carry through, or what's just a boop, and it's really not anything at all. Okay, it's a difference between seeing a human being's footprint, maybe in the sand, a little bird, or you just see a little toe. Okay, this is what banks look like when they're taking positions in stocks. And WSM is a great example today. So how do you read the footprints of institutions, and how can you pinpoint a trend accurately? Well, I'm reading institutional positioning in stocks with a rating system, and I use this to read the price, okay, to tell me what the price is going to do before it does it. It focuses on the daily chart of a stock to determine, based on the price of the stock is being bought, sold, or shorted. If an institution is taking a power position in a stock, you don't have to be with the overall trend of the market. That's a beautiful thing. You only have to focus on the power and money direction in that stock, because once they make the decision and they step into it or pull out of it, rip it up and pull out of it, okay, that's it. That's decided. And they decide it before they do it, then they do it. You can see it, though, when they do it, and then you can decide to play with it. It's just that many people don't know how to read that, and they don't know how to read what this footprint looks like. And so I created a system where I rank the stock based on the daily chart of it to figure out what the price is doing to tell me what that footprint says. So the rating system looks at 26 things on the daily chart of a stock. This is how I trade every day. And the rating system is a checklist. I go down, I check it. 1, 2, 3, 4, 5, I check it off. The checklist tells you what to look for in the price of the stock to read direction correctly, which is important because that's how you're going to make money. And the points tell you where the money is flowing. Why does this matter? So you know what direction to take the position to profit. because again, you have to be in the right direction. I'm very good at reading directional trend. That means when is something a long and when is something a short, okay? And if you can even just do that, go long, good, and go short well, and read directional bias well, and with good money management, actually you can make money in the market, even if you don't get huge moves in something some of the days. Because just many people just don't trade stuff in the right direction. You know? Could you have shorted the market today to make money to the downside? Yes. Was it a good short? The answer is no. No, it wasn't a good short. Market fell today, but the market's in an uptrend. So I didn't short it, okay? Because at any point in time, at any moment in time, at any second in time, power money could have come into the market, buying could have come into the market and taken everyone out, stopped everyone out, blew through, and don't be surprised when that happens again, okay? Because it will. It's coming in again. I don't know where, but it's coming in again, okay? And I'll see it in the gap tomorrow morning. But the point is that know that when you go against institutions, be prepared to basically not win. It's like a 50-50. Like you're better off just going to a casino, basically. Whereas if you trade with institutions, you feel very high odds and conviction in what your choices are and that the stock and the trade is going to work out. Who controls the market? Big money, power money, Wall Street, the players, the people that are doing it, the people that run the money, more money than you could ever dream of, more money than you could ever have, more money. You can't even conceive of the amount of money. You could try to conceive it, but you wouldn't. If I drew a picture, we couldn't even conceive it ourselves. It's so much that you can't even conceive it because it actually moves the market and moves stocks, just like WSM today. So power money in the market is created by institutions who set the tone for stocks, move on the day, and if you can become a specialist in defining when institutions are buying or selling, then you will have a huge advantage in your trading. Power money sets the trend, makes the trend, and changes the trend in charts. And if you are not trading on the side of power money in the market, you will have a hard time seeing lasting and consistent success in your trading. And it doesn't matter what you trade, whether it's equities, options, anything, you want to see lasting and consistent success for the hard work that you've taken to learn how to do whatever it is that you do, and that means you have to be on the side of the institutions, and you have to learn how to read and trade on the side of institutional money. You can learn how to do this. It is a skill. It's a skill, and it's a skill that can be taught and learned. Institutional money is in charge in the market and stocks at all times, and even if you think it's not there, it is. And that's why I'm pointing out the market today. You may think it's not there, that the bulls aren't there, but they are. They're there, okay? They didn't show their hand today, but they're there. It's in charge, in the trend, all the time, whatever it is. So learning how to read the footprints of institutional money can turn your trading around. It can take somebody that's actually a bad trader, a loser, someone that loses, and turn him into a good trader, turn him into a profitable trader. If they could just learn how to read this, it can turn somebody into a profitable trader because it really isn't that hard to have gone long WSM today. You could have almost gone long that anywhere today in the first 15 minutes, half an hour of the day. You could have just pressed the button to go long and walked away, came back at 4 o'clock, not even put a stop in, which I wouldn't tell you to do. But if you did that, you could have come back and just taken it out, and you would have made money. It's almost like seeing what it's going to do in the footprint and then taking the trade of the footprint. It almost doesn't even take that much thought, but you do have to read the footprint. So how can you read the side of institutions in the market? Again, the checklist. It helps you read price correctly. And really, how am I doing this? With gaps. And I kind of was talking about this a little bit earlier because I was talking about the gaps in the market. But I do this by reading gaps. And that's part of the process. That's the foundation. That's the strategy. The strategy I trade is gaps. The checklist tells me how to trade the gap. Okay? So gaps are a secret ingredient in charts that many people overlook, and yet they hold a lot of significance. Gaps are a definitive and demonstrative change in show of the price in what is called an event. An event means a price event. Today, WSN gapped up. Closed yesterday at 59 something. Gapped up today at 63 something. That's an event. Something happened. I don't know, but we can all agree that an event occurred, and therefore the stock moved $4 higher into the open, and then higher on the day. So gaps are a real show of the power of money. Gaps either continue the trend or in fact change the trend. And if you follow the gap, you'll be following the power of money. Now, let's look at this here in the WSM. Actually, this is another beautiful chart here that back in a year ago, actually a year ago here, you could have bought the WSM gap. See this here? This is an institution, or a bunch of them right in here. They bought this around $47, and you could have bought it with them. And you could have bought this as a trade for your retirement, or you could have day traded it. Stock rallied up. Do you think this is extended? Do you think this is extended here? You want to short WSM here? You want to short it? You think it can't go any higher? Look what it did. Came in, gapped up, rallied. Gapped down, wasn't a good gap down. Came in, rallied, gapped up again, made new highs. Came in, gapped up again, made new highs. Do you think it's extended now? Let's see. Comes in all the way here, holds, gaps up again, and gaps up again today. Okay? So this is, again, I mean, someone even said to me today about that this is gonna be a short again soon, but it's extended. This is an amazing show of strength here today in this stock. Please do not short this stock. It is not a short. It is a beautiful, beautiful long, and I wouldn't be surprised if this holds all year, just like this puppy down here. Look, that gap held all year last year. I wouldn't be surprised if that one did too. Okay, so this is an example of institutional buying. So there's one thing and one thing only that can move the direction of a stock. It doesn't matter if it's up or down. It's not a little bit of money, and it's really not traders. It's a lot of money. It's called power money. I just made up the name, but it's a good name because it fits. Power money is in charge. Power money is in charge of the stock's direction. And that WSN back here did lower highs and lower lows. But the power money was there. It was there, it was there, it was there. And how did I know? By reading the gaps, the quality gaps, the highly rated gaps. And you might have thought it wasn't there, but it was. It was there. You might have thought it wasn't here, but then it was. Look, it even broke the 200-period moving average here in the daily chart, but oh, there it was. It was there. It was there all the time. It never went away. Okay? So power money is in charge of the stock's direction all the time. Trends are set and moved by the power money people, of which there was a lot of in the market. And the amazing thing is that as negative as traders and analysts talk about the power money people, they are the reason that one individual can be successful in the market. So congratulations. I'm happy they exist. I'm glad there is hedge funds out there and banks that tell me what to do. Otherwise, how could I make any money? I'd never be able to make any money in the market if that footprint wasn't there and so clearly defined. I wouldn't know what to do. I wouldn't know what to do. I wouldn't be able to make a lot of money doing this, but I can. Why? Because they're there and they exist. All you have to do is learn how to read them, and not only that, you can't be against them. And so many people miss the boat with this, okay? You cannot make money without power money. You got to have them. So live with them, enjoy them, be with them, get friendly with them because they control the market. And use gaps to read it. Gaps can happen in the market on a regular basis. However, some gaps are better than others. And the most important gaps in the market are gaps that signify a change in direction. Understanding which gaps are meaningful and which gaps are not meaningful in the market will help you to know what to do and when the change is occurring. And that's why the rating system is so important, because it tells you what gaps are good and what gaps are worthless, because not all gaps are good. So here's the JCP. JCP gapped up not that long ago. This was back here at the end of February, gapped up. Closed the night before here at $6, gapped up over 7, over the 50-period moving average, over the 20, over the 8, gapped up over the resistance. I don't know the reason for the gap. It doesn't matter. It did gap up, and it's a fairly sizable gap up. Held in this area here of what appears to be support because it's the 50 on the daily chart. And then look what it did here at a big green bar. Then it gapped up again. Then it gapped up again. But guess what? The institutions controlling the stock in JCP are to the downside, so therefore this is not a quality bullish gap here or here unless it rates good enough according to the system, but it didn't. Okay, it didn't, so I didn't buy it. Could it have? Might it have? Yes, but it didn't. So again, I look at a 26-point rating system. The rating system tells me the stock has to rate 20 points or more. 20 points or more, if I read the price of this thing here and it says do it, I'll go along it. And if it doesn't, then I don't, okay? Now, there's nothing to do in here, okay? There's nothing to do in here because the stock keeps gapping up, and this might have a nice bullish gap here soon. It might, I don't know. You have to watch it. If it does, you can buy it if the gap rates 20 points or more. Otherwise, there's nothing to do here. You're just doing nothing here with this right now, okay? And this is what happens. Many people just, anytime something gaps up, they want to buy it, but it might be a nothing gap. This might be a nothing gap here. And then if you buy this, you could get up in the morning one day, someday, and it could be at 4. And then you're down $3. So you can't buy stuff unless it's quality. Just like you can't short stuff unless it's quality. Okay? So gaps have to be qualified by using a checklist. Some gaps are great. You do what you do with them. You buy them or sell them. Some gaps are nothing gaps, and then you just don't do anything with them at all. Okay, there's no footprint there then to do it. You have to be able to read the footprint. The checklist is what tells me that. It tells me if there's a real footprint there of the institutions. It tells me if the footprint is coming in and pressing it, if it's pressing it down, or if it's lifting it up, okay, to rally. So the key to trading stocks successfully is to be on the side of institutional money, and actually this is the key to being a successful trader. And it doesn't matter what you trade, it doesn't matter how you trade, the genre you trade, whatever you do, you've really got to be with institutions in the market. You're going to have a hard time being consistent without it because you need them. You need them to make money. Now let's look here at Staples. Staples had a beautiful, beautiful, beautiful bearish gap that happened last week. Fell off the planet, broke again today. This was going to continue anyways. Now this got some help today from the market to break fast because this gap just happened here last week. This is only a week. So look, in 1 week, you could have shorted this here, stayed with this for an overnight swing trade. This is all the way down. Next target on this for the overnight is 10. It's going to get there. But what happened is that Staples got sold out by institutions in the gap that happened here. I rated the gap. I rated it as a bearish gap because it is a bearish gap. Stock closed the night before here at 1340. Gap down and opened around 1190 something. It was a quality bearish gap, and the answer was to short it. The answer was not to buy it. Let's look here at the first initial opening activity of the Staples play. This is a 1-minute chart. Okay, I trade in a 1-minute chart in the morning aggressively when I trade my gaps to take the positions. If you thought that Staples was going to fill the gap, was going to go up here and rally from where it opened and rally up $1.50. If you thought you were going to buy it, you got stopped out. It did hold the low of the day here for the first 5 minutes of the day, and it did do a buy setup, but you could have bought the stock here. If you didn't put the stop through here, here is where you got stopped out. That made the big red bar here. You see why it's so important? Look at this, right? Because if you thought this was a long, you got stopped out here. Then you might have looked at this and said, I'm going to short it, but you're shorting this very late. I was in this all the way up here, shorting it. I actually shorted more of this into here when it retested the high and held. I'm looking to short this gap, not buy this gap. It's a bearish gap. It's a highly rated gap to the downside. Institutions are pressing on it. So pretend I had an arrow here and I was drawing this. The selling pressure is coming in on this. That means the power money people aren't going to let the stock go over this level here. They're pushing it down. They're saying we're not letting it go over that. We're going to sell more. We're going to short more. We're going to push it down. We're going to hold it down. It's not getting over there. We're in charge. So a million traders could try to buy this and push it up, but the power money people are pushing it down and they're not letting it go over that area. And that's the right way to read it, and it was a really good trade. Entry time was 9:35. Price was 11.93. Stop was over 12.05, and it must be because if this would flip over the high, you want to be out. Risk was 12 cents. This is an advanced risk here if you took a risk of 5,000 shares, which you could do in Staples, and there's plenty of volume. For $600 risk, there's 2 exits. You could have chunked it out. Again, you're chunking it out. You could have taken half out here and booked 575. You're break even on the day then at the first drop off. Hold the rest down, the other half of the position down into the drop off. Profit was 1,700. This is actually a very conservative way to play this. Total profit 22.75, and the risk to reward in this trade is almost 4. It's 3.8. Your goal in every trade should be to make $3 for every $1 that you risk. There will be days when you don't do that, where you risk 1 and make run, or risk 1 and make 2. But your goal should be 3, and actually many days you can make more than that. Okay? So this turned $600 into $22.75, and how did you do this? You traded with power money, and you were never down. You were never down when you took the trade. You were never down when you take the trade, and that's another sign. It's another thing I do very well in the morning, is that I can read what the institutions are doing with the price of the stock into the open. Into the open, I see it because that's typically when they're doing what they're doing, and you can make a lot of money doing this because if you take a good entry, you have a great risk to reward here. With the stop, you see it, it sets up, it goes, and then everybody else is seeing this on their scanner. They're like, oh, Staples, 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 and then they're shorting in here, and then they're pushing down, and meaning you're all the way back up here. So as soon as you take the trade, you're up. Another great sign that you've got the directional bias correct. Okay? And it was a really nice trade. This just broke today. I don't know where it closed. Staples is lower. Again, institutions. Institutions are making this look. Institutions are following through on this, and it's a beautiful play to the downside. Okay? And a really nice day trade. Now let's look here at the WSN. This is at one point here today when I clicked this. Again, the real target, this could have gotten to 70 bucks today. Now it didn't, it did not, but it could have. And if it had the market with it, it probably would have. But that is the next target. Again, this is not a short, and we'll have to see exactly how this holds up in here. But here was the 1-minute chart on WSN. If you watch this in the morning, it showed immediate strength in the morning here. Immediate strength, and I squished this together so you could see how this rallied here. This is a 1-minute chart. Okay, this is 9:30. This is into the lunchtime period, how it rallied all the way up here. I don't think it made it over 66 into the close. But it still had a beautiful move down from the low in here all the way up to here. It's more than $3, and that's a great play. And the entry was right around in here at 10 o'clock. So the entry time, this is for a long. This is a buy. This is power money people buying the gap. Entry time was right at 10 o'clock reversal time. Price is 63.66. Stop is under 63.40. It's a good stop for this price point of this stock here. Okay, 26 cents and a $63 stock is good. 2,000 shares, again, an advanced risk of 520, piecemeal out. First drive up, get out of half. You book 840. Second drive up, and again, this actually I think got up to 65.85 at one point. You book the other half, 2,090. Total profit you could have made on this today is 29.30. This was a really good trade. Over 5 times the amount risked, okay? So once again, you're trading to the long side, to the upside. You're going with the power money. You're reading it. You're reading the gap. You're reading the gap. You're rating the gap. You're qualifying the gap. You're going through the checklist. You're going to see if this is really a good one or not. Is it going to get bought and fought through in the day, or is it going to sell off? Is this a nothing gap? Is it a failure? Do I want to buy this? Do I want to short it? Was this aggressive to buy this today? The answer is yes. Why? Because the market did power trend down today. Was it aggressive? Was it a big gap up? Yes, but it worked. And if you qualified the gap per the rating system, it was a good bullish gap, so you knew to do it. So you follow the system. You follow the system. If you follow the system, then you can go with what the institutions are doing and trust it because it's reading the price, okay? So you've got to learn a method to read power money. I teach a class. It's called the Golden Gap Course. This course that I teach teaches one strategy, which is gaps. It's to trade gaps effectively by reading the side of power in charts. That's what I do. The course teaches how to read support and resistance to take positions in the right direction. There are a billion levels of support and resistance in any chart. Okay, we could probably line 1,000 people up in a row. They would all write the different levels. Okay, and I just told you one area of support in the QQQs today was 88.87, which was low, the low of that tail and the gap where the market came into today that held as the support. But the fact is that you have to be reading the trend right to get the levels correctly and know what to focus on and look at. And too many people are looking at pivots. Pivots give you a certain amount of information, and so do things like moving averages, but they do not tell the whole story, okay? The course teaches a more proficient and advanced way to read charts focusing on technical analysis and gaps. And the course teaches how to get conviction in your trading in the market as a source of wealth, because that is what the market is for people that decide that they want this to be what they want to do, which I made a decision a long time ago, okay? So if you really, really want to take advantage of the wealth in the market, then you have to be with the institutions. And you've got to trade with the side of this power money, and you have to understand that being successful means being consistent. And it's not about risking a lot of money to make $1 million in one trade, doing crazy things like shorting things that are extended or buying stuff that you feel you're getting a bargain price with down. That is a novice approach to trading. That is not the way professionals trade. It isn't. Okay, and when professionals take a position in the stock and change the trend, they are doing that for a whole host of reasons, an analysis that many people are doing that is nothing that we know about, okay? So we have to see that first before we take the position, okay? You see it, and then you do it, and then that's the confirmation. So it's about trading with institutions in the market. Here's the SPY. The SPY came down here into the low today, broke the 20-period moving average, really fell into the afternoon, fell all day here after it broke. Actually, after it broke this one level in here that it held yesterday afternoon around 12 o'clock, I said the market's going to fall all day now. And you could have shorted it, but again, I didn't. But anyways, the low here is, guess what? take it across. It's the open of this gap here. So this is a gap down. It's actually within a penny. It's within a penny. This is 184.65 is the open of this bearish gap here. The low here is 184.66. Now again, I don't know what the market does tomorrow morning where it gaps. I don't know if the market's going to gap down here, gap up, gap up, gap up. I don't know what the market's going to do. I will read the gap tomorrow morning, and you can even rate the market gap to know whether to short the market tomorrow or buy it. But I do know that the market came in today to support, and that the market is in an uptrend, and that the market is continuing to make higher highs. And even though the market had a red bar today, this market is not showing signs of weakness to fall off a planet. And if you don't believe me, go back here and look at this was in January, and the market actually had a couple gap downs here, 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 and even here, and all it did was come in here and flip the running rally. And then ended up going up making new highs in February and March. Okay. And here's a bullish gap here in the market. Look at that guy there. Look at this bullish gap here in the market. It's gapped up, sitting on the 20-period moving average rally. So don't ignore the fact that the market is strong here and start to get all crazy thinking about shorting this toppiness. Okay? You have to read what's going on here in the gaps, and you have to rate them to see, to know what to do. What is the market going to do? I believe the market's going to follow through in the overall trend, because trends do tend to continue until they don't. And how do I know when they don't? I see a footprint of institutions in the market, and I see a gap that actually makes me go, woo! And then I see a gap that's real, and I see a gap that would change the direction of the chart or the market, which I have not seen and do not see, and is not happening here yet. Okay? So when you trade with institutions, you have an edge. This is you. You're happy because you're making money, and you only work for a couple hours a day, and you work from home, and you have a pretty good life, and you have actually a very good life. And these are the people over here that are trying to short the tops, and they short one level of resistance, they get stopped out, they short another one, and they get stopped out, then they short another one, they get stopped out, and this is you. You're doing it the easy way. Just saying, okay, well, let me figure out what the footprints are doing, let me figure out the institutions, let me just trade with them. If I don't see anything that I won't trade today, I'll just take the day off, and you're very happy. Good traders work smarter, not harder for their money. And you have to be consistently profitable to be profitable. You have to. And you have to get a plan of action in place. You have to start somewhere. You have to make $1,000 a month before you can make $2,000 a month. You have to make $3,000 a month before you can make $6,000 a month. You have to make $6,000 before you make 10, 10 before you make 20, and so on and so forth. You know, it's about getting it consistently. You could risk $1 every day and trade for a month. And if you could prove that you could make $3 in every dollar that you risked and were profitable, then you could risk $2 in every trade. Then you could risk 10. Then you could risk 20. Then you could risk 50. And then someday you'd end up risking $500 or $600 in a trade. You can have days where you make 3, 4, or 5 grand in a day, and then you're singing and dancing, and you're working from home. You have to prove that you can do it by putting a plan of action in place of what to do. And you have to be consistently profitable as a trader if you want to make it. It's not about getting the home runs. It's not about the swings. And it's so emotionally devastating for you to have those swings. If you're not consistently profitable, then you need to have the right plan of action in place. And I suggest to pull yourself back and do some self-evaluation until you get that plan of action in place. Otherwise, you chance going off a cliff. You need a plan of action, and you need a reliable system. So put a plan of action in place for yourself, and if you do not have one, stop. Take a little break. Take a 3-day weekend. Take a little time off. Just watch the market, sit back, and figure out what you want to do. Because you have a certain amount of money. It is not unlimited. In your trading account, it's fixed. And you have to decide, what can I do to maximize this account and start to be profitable if you're not. And if you are profitable, you can be more profitable by learning something that's really going to give you larger moves, like the WSM today and the staples. So the goal for me, and this is what I'm teaching people, so number 1, trade only golden gaps. They're rated according to the 26-point rating system, and that's what I use. So that you have a high rate of success in your directional bias in the stocks, in the market. Get the best entry you can with precision early in the morning. To get good risk-to-reward trades, you're looking for 3 R's minimum. R is the risk-to-reward. R is the risk amount. And number 3, your goal is to make money. Don't forget that. Your goal is not to play Ms. Pac-Man on the computer every day, pressing the buttons and over trading. Your goal is to make money. If you don't see the trade, you don't take it. If something doesn't meet their criteria, you don't do anything. You turn off the computer if you don't trust yourself to follow your own discipline and go to the gym. Your goal is to make money as a trader, even as your own person, your own individual in your house. You have to act like you're a professional, and you have to take it seriously. Is it fun? Yes, but it's fun making money, actually. It's not fun losing. So it's fun to make money, okay? And actually it's fun to be serious, because when I'm serious, I make money, okay? So the Golden Gap rating system pinpoints institutional footprints with extreme clarity. You can see it. It's right there. You can see it, okay? So the class I teach teaches the 26-point system and the best stock to rate each day. The course teaches what direction to play the stock, how to enter it and exit on the live day, and it teaches you how to read institutional positioning in stocks. The reliability in what I do is in the 26-point rating system. So learn more about institutions in the market. If your goal is to be a good trader, and again, it doesn't matter what you do. You can do options. You can do anything with this at all. I don't trade options. You have to learn how to do the options from someone else, but I can teach you how to read the directional trend. I can teach you how to read the gaps. I can teach you how to read the institutional footprints, and then you can do what you're doing learn from someone else, the methodology to take the position, actually. But I can teach you the directional bias, and I'm very, very, very good at reading this. And the interesting thing is I love to short. I'm like the shorting queen. I am shorting stocks and created this system in a bullish market in the last 5 years, and it works. And I'm against the market in everything that I do because I like to short. And guess what? I'm also calling the market long. I'm calling the market higher, and I'm shorting every day, and it's working because I'm reading the gaps, and I'm reading them correctly, and I'm reading them with the power. So the class is called the Golden Gap course. It's a complete system to use to trade. It's a full 2-day course on how to strategically find, pick, and play stocks that are professional bearish gaps. And again, the professional is the key word there because you want to trade like a professional. I want you to be a professional. I want you to take it seriously. You can take trading seriously for 30 minutes a day for 1 hour a day. You'll make more money in that time of the day than you will if you're just lollygagging around for 8 hours from 9:30 to 4. You want to be serious about what you're doing, okay? Class is online. The dates of the class is March 22nd and 23rd, which is next weekend from 9 o'clock to 5 o'clock Eastern Time. The cost is $24.99. If you're interested, email me at melissa@thestockswoosh.com. Thank you so much for having me. Thank you, everyone, today. Be careful in the market. If you go into the market tomorrow morning, when you look at the market gap, don't get crazy about shorting this market. Think about what I told you today. The bulls are still in charge, and be careful when you trade. Let this market shake out what it's doing before you decide to do. Please don't short this resistance in the market. The market is very strong. Think about what I'm saying here. Thank you.
Okay, thank you, Melissa. We definitely appreciate you joining us today and presenting that wonderful presentation. And don't forget, the actual email was melissa@thestockswoosh.com. And just once again, thank you, Melissa, so much.